Welcome back, friend. In our first session, we laid the foundation with an overview of the Income Tax Act 2025, its structure, legislative intent, and the board framework that will guide us on going forward. और आज हम इनकी इंट्रिक्सीज यानी वे जटिल पहलू जो प्रैक्टिस में महत्वपूर्ण है उन पर चर्चा करेंगे. Friends, it gives me great pleasure to once again welcome CA Gautam Nayak sir, who bring with his vast experience and deep insight into income tax law. In today's session, he will guide us through the critical nonsense and gray area of the Income Tax Act 2025. Now I request our past convener, CA Jayesh Jisa, to give a brief introduction of our speaker, CA Gautam Nayak.
Thank you, convener, for the opportunity. It is my distinct honor to introduce our esteemed speaker for today's second session on Income Tax Act 2025, Sri CA Gautam Nayak. Gautam Nayak is a stalwart in our profession, particularly on taxation field. He is known for his analysis on direct tax. He is a recognized authority on corporate taxation, transfer pricing, and regulatory advisory. Currently, main partner for the CNK and Associate. His commitment to the profession is best highlighted by his leadership at Bombay Chartered Accountant Society. He is associated with Bombay Chartered Accountant Society from last 3 decades. He was a past president of BCA and regular writer in BCA Journal as an editor. All of us has enjoyed his writings and beyond his leadership role, Mr. Nayak is a prolific speaker and author. He has contributed in various publication of institute. He is a regular writer in BCA Journal, and he is a regular speaker at various forum of institute, ICSI, IMC, and many more. He is a regular writer in newspaper, Economics Time, Mint, and other publications. Known for his ability to simplify the intricate tax amendments ranging from union budget, where we have called him at various occasions, and changes in complexity of the Income Tax Act. He brings a practical, hands-on approach to his analysis. Today, we are fortunate to have with us to guide us through the Income Tax Act nuances. Please join me to welcome Sri Gautam. Yeah, please. Now, before he gives his speech, I request to hand over the mic to Madam Sir. Madam. Gautam sir.
Very good morning to all of you. Madam Tanwani, Principal Commissioner of Income Tax, Central Council Member Piyush Chajet, the leaders of the study circle, and dear friends. I think after a very interesting session from Piyush, well, I'll be covering, of course, some of the things. There may be some bit of overlapping, but as Piyush mentioned, one of the things I will cover in a little bit detail will be that of charitable trust. So bear with me if there is some overlapping, but perhaps there may be a different perspective which I may bring to some of those points which Piyush has made. Now, if one looks at these provisions, how did this new Income Tax Act 2025 come about? You had the Finance Minister's budget speech in July 24, where she said that I'm announcing a comprehensive review of the Income Tax Act. It is to make the Act concise, lucid, easy to read and understand. This will reduce disputes and litigation, thereby providing tax certainty. It will bring down the demand embroiled in litigation and propose to be completed at 6 months. So this was the objective which was laid down by the Finance Minister. And one of the things I think, of course, if this time they have issued FAQs, etc., which came out with the bill, and we should mention that the existing act was amended nearly 65 times with more than 4,000 amendments, and all of us have got used to 100 amendments in the Finance Act every year. I mean, the Income Tax Act every year. That's why you have these huge budget sessions. I think the study circle must be having a large attendance at that. But the point is, every year, 100 amendments, is it something which is required? And the point, I think, is also, if you look at those FAQs, one of the points which was made is, why is the act amended so frequently? They said that because the Income Tax Act is economic legislation, and as the economy changes, law has to be changed frequently to keep up with it. Now, I understand to some extent, yes, some of the amendments are necessary where you have new topics like crypto, etc., all those things. But at times, sometimes one wonders, should there not be some sort of stability in that? But unfortunately, I think the way it is looked at is that today, Income Tax Act 2025 has come in. It is bound to be amended every year. So you will still continue to have your budget sessions. So it's something which you will continue to. So it's not that with this, you will have stability for 5 years. That's not going to happen. So that's something which you need to remember. So a bill was introduced by the Finance Minister in February 25. That time, FAQ was a navigator which compared what were the provisions, earlier provisions, new provisions. And of course, they said that the effort is not just linguistic simplification, but also structural restoration. 60,000 man-hours of the departmental officers, 150 officers were involved in the exercise. They went to Delhi, sat down, and they had marathon sessions. So a lot of effort has gone into it. And frankly speaking, I think the way the language has come out, the language has been very good. It's much easier to understand than the old act at times. It's particularly if you look at the tables, the say, etc. I think yes, they have done a very commendable job. I would say that. So there are 536 sections as against the existing 819 sections. Currently, there are no alphanumeric sections. But as you know, the Income Tax Act 61, when it came out, also it did not have alphanumeric section. And today you have a 80 JJAA. You have, so it goes up to 4 alphabets. So I don't know, maybe, but this depends on the speed of which changes come. So therefore, it will, again, something very. You have 23 chapters as against the existing 47 chapters. But that's a little misleading because some of these chapters have 6 or 7 sub-chapters. So therefore, it's there are 16 schedules as against the existing 11 schedules. Now, this is something which is done very well, I think, because if you look at it, a lot of things which were there, you had section 10, and now section 10, a lot of that has gone into schedules. So it makes it a lot easier to understand, it's more precise. It's, of course, your section 10, you have an equivalent section 11 today. That section 11 says that income referred to in so and so schedules will not form part of. That's all. It's just a 3-line section. Whereas your existing section 10 turned into maybe 30 pages, 40 pages. So those are things I think which are, there are 2.6 lakh words against 5.12 lakh words in the existing act. So the number of words is also reduced. As I said, the language has been simplified. Now, provisos have been completely eliminated. There were 1,200 provisos in the existing act, which have been completely eliminated. There were 900 explanations which have been eliminated as per the FAQs. And it's simpler, easier to understand language. So what has happened is all the provisos and explanations have gone into subsections. And now, is that a simplification or not? One will have to wait and see, because the question is that we always understood that a proviso carved something out of the main section. The explanation supplemented the main section. Now, when you have a subsection, which subsection will override what, etc., is something which is bound to arise. These questions will arise from a legal perspective. There are 57 tables which are used to combine sections to better clarify applications in different situations. And when we come to TDS, we'll see, I think TDS, for instance, I'm very happy. I think the way it has come out, it's come out much easier to understand. You have one table for residents, one table for non-residents, one for non-deduction of tax at source, etc. Many places they've used formula, and that's again something which has been very useful. I think, for instance, your LIC policies exemption. LIC policy exemption, each policy issued between this date and this date, the 10%, this date and this date, 20%, and prior to this date, no, etc. All those things have been now been put in formula, so it's a lot easier again to understand that. So the point made was that there are no major policy-related changes made in the bill. Of course, I would put this with a caveat, because there have been certain changes. For instance, charitable trust, I think there is a significant change over there. And of course, though broadly it remains the same, but there are quite a few points over there. And the worry is also that if one finds some changes over there, then the question is, other point whether it's a drafting mistake, is that an intended change or an unintended change? Now, those will be the issues which will come up, perhaps. So unless those mistakes are rectified quickly, so that's as I said, charitable trust, there are significant changes in the way the whole thing works. But broadly, the position is the same. There are other changes, which would have an impact either, due to it was intended or unintended because of the use of change of language. So therefore, that could also make a difference. The one good thing that they have done, I think, and very good thing, is that this whole concept of financial year, the assessment year, the previous year and assessment year has been done away with. You have the concept of tax year. So you will now, henceforward, you will not have to start remember assessment year 27, 28, previous year 26, 27. So it will just be tax year 26, 27. So the year in which you earn that income, that is the concept of tax year now. That is and this will the act will come into force with effect from 1st April 26. It was referred to a select committee. A lot of suggestions were made to select committee. Select committee went around the country. They came to Bombay as well. Met various associations. They met certain firms also, including our firm. They had met us, and they also looked at it. They got feedback from the finance ministry, and accordingly, they finalized the report, giving various suggestions. Many suggestions were accepted where there was a problem with the language. Many suggestions were not accepted, saying that this amounts to a policy change. Some of the suggestions were for simplification of the law itself, and which they said that no, this amounts to a policy change that we cannot. So there's a 6,000-page report. It's available, on the website, where the committee views given, the feedback received from the finance ministry is given, what were the suggestions which are received. All that is given in that. And the earlier income tax bill was then withdrawn, and a new income tax bill in 2025 was introduced on 11th August 25 and passed shortly thereafter. Now, how does the transition work? And that's something which we have to understand. So to understand how this transition works, you have to go to the last section of the Income Tax Act 2025. So open the end of the Act, Section 536. So Section 536(1) says that the Income Tax Act is hereby repealed. 1961 is hereby repealed. So when this comes into force, that earlier Act gets repealed for 1st April 26. 536(2) says that the provisions of this repealed Act shall continue to apply to any proceedings, including notices, assessment, reassessment, rectification, penalty, reference, revision, and appeals in respect of any tax year beginning before 1st April 26, and such proceedings shall be carried out as per procedures specified in the repealed Act. So for the next 5 years, you can have reassessment, you can have, of course, your old appeals, your old matters, all that will continue under the old 1961 Act. So if you think that you can only buy the Income Tax Act 2025 every year, no, you may need to also have the 1961 Act also. For the next 5 years at least, you will need to retain that. And I will point out that it's not only 5 years, maybe 20 years, 30 years, you may need to keep it, and it will come to. So it's good business for tax publishers, of course, but that's something which you need to keep in mind. Penalty proceedings after 1st April 26 can be initiated, but again, because they relate to earlier years, whatever relates to up to the year ended March 26 will be under the old repealed Act. So, in fact, your income tax return for the year ended March 26, which you will file in July 26 or September 26 or November 26, that will also be under the 1961 Act. So that's what you need to remember. Pending proceedings under the Repeal Act will continue as if this Act had not been enacted. So whatever was the provision under the 61 Act, you go by those provisions. That's the way it will. And the good part here again is any election, declaration, or option made and in force under the Repealed Act would be deemed to be made under corresponding provisions of this Act. So, for instance, if you have opted for the lower rate of tax under Section 115B or various so those provisions, that option which you have exercised, you don't have to exercise it again. So similarly, if 80 JJAA, etc., you had chosen to claim. Now 1 year was there, and the next 2 years fall after the new Act comes into force. That will continue seamlessly. That's the whole objective. Interest for earlier years receivable or payable, the new Act provisions will apply for the period after 1/4/2026. For the earlier period, your 1961 Act will apply. Deduction or exemption allowed in earlier years becoming taxable. So, for instance, you have under Section 47, you have certain exemptions, and you have 47A, which says that certain amounts will become taxable if you don't. Or under 54, you are supposed to hold the new house for 3 years. If you sell it within 3 years, then it becomes taxable. So 54F, etc. Now, those provisions, if you had an exemption which was allowed in the earlier year, and that becomes taxable by violation of those conditions, this will be taxable under the new Act. So you can't say that no, now the old Act is no longer there, you can't tax me. No, that's not the way. It works as if seamlessly as if it's the same Act which continues. That's the demands which are there under the Repealed Act will continue under the new Act as well. Irrespective, of course, if there are those demands, so you have to get those demands knocked off, etc., very often. But they will continue, and recovery proceedings can also be continued. Any agreement entered into, appointment made, approval given, recognition granted, circulars issued, directions, instructions, notifications, orders, or rules issued under any provision of the 1961 Act, so long as they are not inconsistent with the provisions of the new Act, shall be deemed to have been entered into, made, granted under the corresponding provision of the 25 Act. So you had circulars, orders, and instructions and directions issued under 119 of the Income Tax Act. Those will continue to apply. So if you had a circular issued under Section 54 or 54F saying that purchase of land, and for construction of building, the cost of land will also be considered. Now that provision will continue to apply even under the new Act. So the corresponding section under the new Act, unless that circular is withdrawn. So therefore that will continue. And unless you have a specific provision which says, no, you will not be allowed that. So therefore that will continue to apply. So the old circulars, etc., you will still continue to use. Short-term, long-term capital loss which you had and which is carried forward, there was a drafting mistake in the bill, which they have rectified when the Act was finally passed. So the drafting mistake was that it says that it shall be allowed to be carried forward. So what would have happened is that your long-term capital loss would have been set off against any capital gain, including short-term capital gain, the way it was drafted. But now they have said that in the manner prescribed under the Income Tax Act. So therefore, it will the same thing. Short-term can be set off against both short-term. If you have incurred a loss up to March 26, that will be carried forward, and that will be set off against the same manner. The short-term can be set off against short-term or long-term, or long-term can be set off only against long-term. So that will continue. Carry forward of MAT credit, AMT credit, losses, announced of depreciation, reduction under 35 ABB, 35D, 35DD, 35E of first provision 36. So question arises, what about Section 80 JJAA subsequent year deductions? Does it fall in this? So perhaps would it fall into the option exercise? How will it? So these are some of the gray areas where perhaps the intention is that you should be allowed that. I think, it's just a matter of clarification, perhaps, brought forward written down value. Technically, there's nothing provided over there, but the intention, I think, clearly is that yes, that would continue under the old act, will continue under the new act. Notified faceless schemes which are there for assessment, for appeals, etc., those will still continue under this new act as if they had been notified under the new act. Search or requisition prior to 1st April 2026 will continue under the repeal act as if this act has not been entered into. So if you have a search which is prior to 1st April 26, so in say in the month of March or say January 26, you have a search. Now those search provisions will be governed by the 1961 Act. It's only if a search takes place after April 26 and onwards that the new Act provisions will apply. Otherwise, it will continue under the old Act provision. That is the way that this has been. One good thing is that you have, it says Section 6 of General Clauses Act 1897 will apply with regard to the effect of the repeal. So though the 1961 Act has been repealed, and what does Section 6 of the General Clauses Act say? It says where this Act or any central act or regulation repeals any enactment, the repeal shall not revive anything not in force or existing at the time at which the repeal taken. So if some laws, say for instance, had lapsed under the 1961 Act, it will not get re-enacted. I mean, it will not come back into force after the 1925 Act comes into force. The repeal shall not affect the previous operation of any enactment, so repeal or anything duly done or suffered thereunder. So any action which was taken under the old Act will not get impacted by the new Act. It shall not affect any right, privilege, obligation, liability accrued, acquired, occurred, or incurred under any Act. Now, a lot of these will be, possibly covered under this. If you had a right under the old Act, that right will continue under the new Act. So as I said, 80 JJAA perhaps will fall under this. Nothing shall affect repeal shall not affect penalty, forfeiture, punishment incurred in respect of offence committed under the repeal under the 61 Act. Nothing shall affect any investigation, repeal, legal proceeding or remedy in respect of any such right, privilege, obligation, penalty. So any such investigation, legal proceeding or remedy may be instituted continued as if maybe imposed as if the repealing act had not been passed. So as if this new act had not come into force, whatever penalties, etc., prosecution, etc., all that will continue under the old act. That's the way that it basically. But this, the intention is that you have a seamless transition. Whatever was there under the old act will continue under the new act. That was the whole object and purpose of this amendment. You have the same heads of income. So you have salaries, income from house property, you have capital gains, you have business income and income from other sources. Same heads of income. So there is no new heads of income or anything new to learn on that. Changes in chapters, it's that really it's the same chapters, but the way the chapters, now what you need to remember is how would you look at this new act? When you have any issue today, you cannot just give an off-the-cuff answer saying, no, what was there in the 61 Act continues under the 25 Act. That's not the way you would have to look at it. You will have to open the 25 Act, look at the language, look at the provision. Is this the way, does this still continue or not? And let me tell you that over the last 5 months or so, when you look at the 25 Act, whenever some query comes up, I open the 25 Act, some new aspect comes to light. So today also what I tell you is not, or what Piyush has said is not the final list. There will be still some more finer aspects which will come to light. The more you read it, the more you look at it and you apply it to your clients. So your Income Tax Act 2025 is something which you have to keep on your table all the time. see that any query from a client, please don't answer it off the cuff saying that no, it will continue the way it is. So it's not that way. I think you open it, you'll have to understand, look at the section 536, look at the relevant section, look at how it was under the 61 Act and compare and see whether this new provision would apply, whether the same impact is there or not. And that's something which I think all of us need to inculcate that habit for at least for the first 2 or 3 years until we get more familiar. Because of course, 61 Act, all of us have grown up with for the last so many years. We still need to remember that, as I said, at least for 5 years and maybe a little longer. But some things now for the new Act, everything is new in a sense because of the language change. So it's not, I mean, the intention is not to make a change, but does the language support that? That's what we will have to really look at. Now, when you look at the chapter, as I said, after the GAR chapter, then there is this mode of payment in certain cases, which was there later, but that has been brought earlier. As I said, certain chapters have been consolidated. You had this determination of tax in certain, special cases, special provision related to incomes of non-resident, special provision related to certain companies, which is a MAT, AMD provisions. Then certain, all these have now been consolidated into one chapter, which is determination of tax in special cases. And interestingly, what they have done is that they have also added the charitable trust under these special provisions. So when we come to the effect of charitable trust over there, when we come to that, we'll see that what is the impact of that. So there are sub-chapters over here for each of these. And, you have this one chapter 13, determination of tax in special cases. So your representative SSE, executors, non-residents, companies, business trusts, investment funds, all that, shipping companies, all that is your tonnage tax provisions, all that comes under this chapter. Set up and carry forward of losses. Now, that's a separate chapter from return of income. So that was earlier a part of one thing. Search cases, this chapter has been merged with assessment chapter. So there's one chapter 16, which will deal with that. Special provision applicable to firms. So firms, how the competition and the provision for registered NPOs. Now they will want part of the special provision related to certain persons. Dispute resolution committee and advance ruling chapters, they are merged with appeals revision and ADR mechanism, rightly so. I think that has, and so the order is being changed again. Appeals revision and ADR mechanism is before collection and recovery of tax and before this one refund. Now, one of the things and which I, with due respect, taxpayers charter, I think there was a lot made when this was enacted that we have given due respect to the taxpayers charter. And, so in this new act, and I looked at, I said, this taxpayers charter, oh, that's good that it's being really, because all of us know that we have the taxpayers charter. It is there, on wall sometimes of some this thing, etc. But it is, very often when it comes down to the assessing officer level, when it comes down to actual practice, you have certain timeline laid down, rectification timelines are there, disposal of appeal timelines are there. There are this. But that doesn't happen, 197 certification. So that doesn't happen in reality. And that's where, so we thought, oh, good, now it is now part of the law. But when you open the section, you'll find the section is the same as was there under the 1961 Act. So there is no change. Taxpayers charter is still today. I think if the government perhaps was really serious about this, taxpayers charter should have been enacted as part of this section itself. It should have been brought into the Act. And it would have made a big difference. It would have brought a little bit of accountability on the part of the officers. It would have ensured that people are also aware that, yes, this is a timeline within which my matter will get resolved. What is the position? I think that is something which would have been fair, and it's something which maybe one should still look at, that if there is seriousness about the taxpayers charter, then it has to be brought into the Act itself. That's something which now, basis of charge and scope, you have, so in the bill, interestingly, you had this now, Income Tax Act 61, you have section 222, which deals with the definition of, 222, 224, which deals with definition of income. Now, there was this definition is now contained in section 249. When the bill came in, at that time, there was a residuary clause X. It goes A, B, C, D, E, F, going right down up to X. And the residuary clause X said, any other income referred to in section 224 of the Income Tax Act 1961. So which means that for the definition of income, so they've reproduced everything which was there in 61 Act. And so in the bill stage, then this was there. This was pointed out that this is a duplication, really. Everything you already reproduced, so what is the need for that? So fortunately, at the Act stage, they will report that. So at least for this part, you will not need to go back to the 1961 Act, because now you have Section 249, which has everything. Then Section 4, there again, there was a drafting mistake in the bill, and which has rightly been corrected, where it said that income tax for any taxation shall be charged for provisions of this act at the rate or rates enacted by central actor for such year, was this thing. Now there, you have certain rates which are found under the Income Tax Act itself. So for instance, your Section 115 BAB has the special rates of tax, so there are certain rates which are laid down. So those need not be given in the Finance Act every year. That's the way it today works. Now this, unfortunately, this was not there. Now, fortunately, I think they have, when this was pointed out, they have rectified this in the Act, and it says in accordance with and subject to the provisions of this Act. So where the Act prescribes rates, that need not be specified in the Finance Act every year. So the Finance Act, otherwise everything would have had to be notified in the Finance Act every year. So fortunately, I think this has been changed. Section 5, what is the scope of total income? That there is no change, except that the provisos are now in subsections. So all that is this. Coming to residential status. Now on residential status, you have simplified language, where you have again all those provisos, explanations, all that has gone into subsections now. So the same test of 182 days or 60 days plus 365 more in the earlier 4 years, that's in subsection 2. Subsection 3. The 60 plus 365 is not applicable to an Indian citizen leaving India during the year as member of a crew of an Indian ship. And there was a use of the language, or for purposes of employment outside India was, for employment outside India was the language used, instead of purposes of employment which is used today in the 19th. Now, purpose of employment and employment, there could be an implication. There was a AR ruling in one case where the view had been taken by the AR is that if today, for purpose of employment is a broader term than employment itself. Say, for instance, if you're on secondment, now that was the case of secondment, and then they said that secondment cases, etc., it is for purposes of employment, though it is not for employment. So though you're not employed, but you are going for purpose of your employment. So that was the way that they looked at it. And therefore, I think now they've restored it under the 25 Act. So the language is the same, 61 Act or 25 Act. Your same condition that 60 plus 365 not applicable to Indian citizens of PIO who being outside India comes on visit to India during the year. And where he has income exceeding 15 lakhs, 60 plus 365 will apply with modification of 60 being substituted by 120. And voyage of Indian ship will be as per the prescribed manner and subsequent condition. And citizen of India who is not liable to tax in any other country by virtue of residence and has total income exceeding 15 lakhs. Again, he'll be regarded as resident in India. So that is. Now, NOR, there, I think the language is much simpler now. The not ordinary resident but not ordinary resident, that category. They said, for an individual, again, that 9 out of 10 years, if he's been a non-resident or has been in India cumulative for 729 days or less than 7 preceding tax year. And Indian citizen, again, so they've given alternatives. They are, or if you see, these are the 3 things and they are alternatives. So therefore, if either of these you meet, then you are a NOR is the way that they have looked at it. So it makes it much clearer. Now, of course, the question is when we are talking about simplification, as I said, there has been a lot of talk about saying that this is the act for the new decade, new this thing, etc. And perhaps, it's time that we look at maybe, I don't know, that there has certain simplification. Now, this whole concept of NOR, except for returning Indians or people who, or foreign citizens coming to India for employment for a short duration, does it serve any useful purpose? So can we simplify it? Do we need to have such complex provisions? Is something which perhaps one needs to look at, so these are things which maybe in a structural change, if this was really something which one needs to maybe look at these issues. This income deemed to accrue or rise in India now. So you have section 9 today, which is there. You have section 911. Now that is shifted to section 99. The main part of section 911 is now section 92. And you have this whole concept again here. It's almost the same. Business connection in India, any business significant economic presence provisions are there. And you have this indirect transfer provisions, which today in Tiger Global, you had this question coming up before Supreme Court. So that indirect transfer provisions are also continue. You have expression 5 and 6 and subsection 10. Royalties and fees for technical services. You have similar provisions contained in section 9.6 and 9.7. Instead of 9.16 and 9.17, it's 9.6 and 9.7. There was a drafting mistake in the royalty payments at the bill stage that will be corrected, because there what had happened is that they said that payment by a non-resident to another non-resident in respect of business carried out outside India shall be deemed to be accrued. And it should have been in India rather than, so that has been corrected, that drafting mistake. Payments to a non-resident or not only resident without any. Now there again, here also perhaps there was a little bit of more the seek for simplification, but obviously, I mean, given such a large the seek to this perhaps will remain, because if you look at section, you have section 9.8. So if you make a payment to a non-resident without any consideration for inadequate consideration, which is referred to in 56.2.10, then in that sense, it's deemed to accrue or arise in India. That's the provision. Now here, there's a reference to section 249U, which is the definition of income. And that takes you to section 92.2M, which is the payment without. So to understand what is covered under 9.8, you will have to go to 249U. From there, go to section 92.2M. I think this is something which could have been avoided. Maybe directly there could have been a reference to section 92.2M, read with section 249U, perhaps, So these are things, but these are minor things which, Now, as I said, exemptions, there is a significant change. The exemptions are shifted to the schedules. As I said, section 11 is a very short, innocuous thing, as opposed to section 10, which today, as I said, runs into 30, 40 pages. So that's shifted, all that is shifted to the schedules. You have schedule 2, which is incomes not to be included in total income. What does it contain? It contains agricultural income, life insurance policy proceeds, provident fund, NPS withdrawals, agricultural income definition. Agricultural income, the definition, there's a new limit D where income derived from sapling, seedling, grown in nursery. Earlier, this was an explanation which applied to all 3 clauses. Then life insurance policy exemption, as I said, it's now in a tabular form and it's much easier to read. Then the other thing now, and where I say now you will need to keep your 1961 Act for at least maybe, I don't know, 25 years, 30 years, 50 years. And which is where, because there's the last point of the schedule 2 is any income covered under 10.15.3, 15.4, 15.4D, 15.4E, 15.4F, 15.4G, 15.4H, or 36 of the Income Tax Act 1961. So to find out what is covered under that schedule, is it exempt or not, you'll have to open your 1961 Act. Now, unless this is also amended and you reproduce it over here. Now, of course, now 10.15.4, as you know, is a very long section. It runs into 3 or 4 pages. So perhaps that was the intention, that therefore, this is one way to. Similarly, in Schedule 3, you have this. What is Schedule 3 is exemptions where certain income is not to be included in total income of eligible person. So there's a concept of eligible person as well as income. And say for instance, distribution by an HUF to its members, or share of profit from a partnership firm received by a partner, allowances and perquisites received by an employee from his employer, and my income of a minor, So now there also you have the last item. Any income falling under 10.15.2C, 10.15.4.1, 19.10, 19A, or 10.40 of the Income Tax Act 1961. So your Income Tax Act 61 is required to be kept alongside your 25 Act. So Schedule 4 is again a category of exempt income. Income not to be included total income of eligible non-residents foreign companies. So this is for non-resident foreign companies, which is your NRE interest, your short stay salary that less than 90 days in India, etc. The language is, I mean, the intention is the same, the whole provision is more or less the same. But here also you have these various clauses of 10, 6.8, 6B, 6BB, 15A, 15.3A, 15.3B, etc. All these incomes which are referred to in the Income Tax Act 61 will be exempt under this. So again, for these exemption provisions, you will have to refer to your 61 Act. Then Schedule 5 is of investment funds, business trusts, that is your REITs, AIFs, your InvITs, etc. All that will. So the pass-through income part of it, that's in Schedule 5, you get that exemption is there. And Now here also there's a reference to 1023F and 1023FA, venture capital funds of the Income Tax Act 61. So this is something. Then Schedule 6 is your IFSC, that is your gift city exemptions. So that is consolidated into Schedule 6. And Schedule 7 is persons exempt from tax. And this includes, for charitable institutions, you have various, if you look at section 1023C, you have subsection 1, which is your Prime Minister's Relief Fund, you have the PM Cares Fund, you have your various other funds. And then you have educational or medical institutions which are wholly or substantially financed by government, or educational medical institutions which are with gross receipts of less than 5 crore. Now, all these were 3AB, 3AC, 3AD, 3AE. Now, all these were fully exempt. All those provisos under 1023C did not apply. Now, that is now brought into Schedule 7, and it is under persons exempt from tax. So, therefore, these entities will continue to be fully exempt, and they are exempt under Schedule 7, read with Section 11 of the Income Tax Act 2025. So, therefore, that full exemption continues for small schools, small etc. That will be. And Schedule 8 deals with political parties and electoral trusts, which you have 13A, etc. So that continues, and that's in a separate schedule. So as I said, the exemptions now are easier. That yes, you have to refer to a particular schedule. Of course, which schedule it falls under will depend upon whether it's completely exempt income or completely exempt person, or whether it is for certain income or certain eligible persons, or whether it's gift city or whether it's a non-resident, etc. So all that. Accordingly, you will have to, I think it will take a little while to get used to the schedule, but I think this is a much easier way to do it. It's something which I think something which I would personally, rather than, of course, the biggest advantage here is when you come to this, the 1023C itself ran into, I think, around 10 pages, and that itself has been eliminated. So that's, of course, a big lesson. So that is something which, it's made, I think, will make life a lot easier for all of us. Salaries, you have section 19, which is corresponding to the existing section 16. So deduction respect of entertainment allowance for government employees removed, which in any case was not really. And in any case, for the new regime, it does not apply also. Now, one interesting thing under 17(2)(b) EB. So one thing I would just like to say is, what I'm saying today may not be the position after 1st of February, because we'll have to see in the budget. There may be changes made to this Income Tax Act, because there are certain intended changes and there are certain changes which are made which were drafting mistakes at times. And there are some, of course, because of the language, etc., that has changed. So where the changes are intended, yes, those will continue. But where certain unintended changes, I understand that, yes, amendments are going to be carried out in this budget. And that's where we'll have to wait for the finance bill on 1st of February to understand that. Now, the 72EB, the perquisite, you have an exclusion for expenditure incurred by employer for the use of vehicle for journey by the SSC from a residence office or other place of work. So, it says currently the language uses use of any vehicle provided by a company or an employer for journey from a residence office. So vehicle provided by company or employer is missing there. So therefore, even an SSC's own vehicle, if he uses an employer reimburses it, that will possibly fall under the, will not be a perquisite. So that is the implication of this. Then exemption for commuted pension received from a fund under 1023 AAAB, so that is contained in 1010A. So this is now shifted to section 19(1), which is deduction from salaries. So instead of section 10, where under the exemption section which was there, it's now, so which was exempt for everybody, it is now shifted to salaries. So 19(1), deduction from salaries, section 9 of the table, there's a table there which allows you this deduction for commuted pension. Now, this commuted pension, so far as the employee is concerned, it's fine. But if the subscription to the fund is not by the employer, it is not taxable as salary. It's taxable as income from other sources. Now, this was a mistake again in the bill stage, which has been rectified at the final act stage. And for now, non-employees, now you will get a deduction under section 93(1)(g). Now, 93(1)(g) is the provision under income from other sources deduction, and that's where gratuity received by legal heirs. As you know, if a legal heir received gratuity, that is clearly exempt from tax, because on the death of an employee, if the legal heir received certain amount, there is no employer-employee relationship. It's a capital received by the legal heir, and therefore it was not taxable at all. Now this has been brought in specifically. They've said that it's deductible under Section 93(1)(h). So there is a specific provision now to treat it as exempt. So far as business income is concerned, you have Section 39(1), the definition of actual costs. So there's a special provision now in this to exclude GST in respect of which input tax credit has been claimed and allowed. So in any case, today you bought a fixed asset. Your GST, which you claimed as you set it off, you claimed it as a set off in your, that obviously was not included as part of your cost in your accounts. So to prevent you from this, they've now specifically said that that will not form part of actual cost, that amount of GST on which you've claimed a set off. Presumptive income, I think is more or less, you look at this thing. It's corresponding to, they've combined all these sections. So 44 AD, ADA, and AE have been consolidated. There's no change in the limits or rates. So what has been there, you have a table which in columnar form, one column is specified business or profession, assessee to whom it's applicable, what is the total turnover, gross receipts up to which it's eligible, and the manner of computation. So these are the four. So it makes it a lot easier to understand as opposed to a separate today reading whether you fall under 44 AD, ADA, or this, etc. So this makes it a lot easier to understand. Now 58(4) says any loss, allowance, or deduction allowable under provisions of this act shall not be allowed against the income computed in the manner computed under subsection 1. I think if you look at the Income Tax Act 61, it says any deduction allowable under sections 30 to 38. I think this is again a drafting mistake, perhaps, which was the thing. That now, for instance, deductions allowable under Chapter 6A, 80JJAA, for instance. Now, that is a deduction under Chapter 6A, which is allowable today under the 61 Act. I don't think the intention was, to deny you that deduction altogether, but the way it comes is any deduction allowable under the provisions of this Act is the way that they've. Now, there was, of course, some mistakes in the 61 Act vis-a-vis, where the audit is required, 44 AD. Today, it was only required under the, if you see the 61 Act, it was only required in cases where the assessee with income exceeding the basic exemption following the presumptive rate in a year does not follow presumptive in the subsequent year. So in year 1, you have opted for presumptive tax, and in year 2, you opt out of the presumptive tax. Then you are required to do an audit. So it was not in year 1 if you were below the the thing that the rate that you were. So now that was I think and 44 ADA, which is for professionals. There it says if you are claiming income less than presumptive tax for any year, though your income exceeds basic exemption. Now they've said that okay, this applies to both cases. So I think that was a mistake in the 44 AD, which has been rectified. So this is now Section 2(105), this is definition of stamp duty value. As you know, stamp duty value is there, your 50C. 50C refers to the stamp duty value. There was the references to state government thing for the stamp duty valuation. So the rates prescribed by the state government. Now there are very many which fall under union territories, or therefore where central government notifies the stamp duty rate. So therefore this has now been corrected, saying that there is reference to central government authorities as well as the state government authorities. So that's a rectification that has taken place. And the Section 72, the mode of computation of capital gains is which is equivalent to your Section 48. So what was happening today is that you had in 112, you had this reference, you had the proviso, 23rd July 24, as you know, if you had a property which is sold after 23rd July 24, and then they had an exception saying that if the individual or HUF had acquired prior to 23rd July 24, they would get the benefit of indexation. This is, so they will get the benefit of indexation. Now it's contained in the section itself. It's the thing. So Section 197(3) read with Section 72(2) will give you this same benefit is there. 72(8)(d) talks about again the rate for conversion of INR into Forex and Forex into INR to be prescribed. You have your Rule 115, today, which gives you those rates, etc. So similar this. Now, market-linked debentures, as you know, you had section 50AA, which says that on market-linked debentures, any gains will be short-term capital gains. So there the language used is shall be deemed to be capital gain arising from the transfer of short-term capital. The new act says it shall be treated as short-term capital gains. So the question now will be, does the asset cease to be a long-term capital asset? So when, so that's the thing. And 197(1), which prescribes the rate of tax, it says where the total income on SSE includes income arising from transfer of a long-term capital asset. It doesn't say it includes long-term capital gains or includes short-term capital gains. So this is, I think, something again which perhaps is a drafting, but primarily the same thing continues is what we have to remember. The intention is that it's the same thing. 54 EC, the investment in capital gains bonds, section 85 there. And as you know, you had the Supreme Court in the case of Bombay High Court first in the case of Ace Builders, and then the Supreme Court in the case of VS Dempo confirmed that if you have a capital asset, which is a long-term capital asset, which is a depreciable asset, and you sell that depreciable asset, you invest the capital gains, though it is deemed to be short-term capital gains, but that deeming fiction is only for the purpose of competition. And if you invest it in these, you can invest it in the bond and claim the benefit of exemption because the asset was still a long-term capital asset. That was what the Bombay High Court held in Ace Builders. Supreme Court also confirmed this in VS Dempo. Now, this may no longer hold good under the new law. Because I think the intention was never to give you, if you look at the return form, even today claiming that in the return form is a challenge because the return form does not allow you that, though the Supreme Court has said that. And it says, where an SSE has long-term capital gains arising from the transfer of land or building is the language which is used now in section 85, which is equivalent to 54 EC. And, and section 74 says it's deemed to be capital gains arising from transfer of short-term capital assets. So here again, you will have to look at it. If there's a depreciable asset transferred, which is a long-term capital asset, say a building which has been held for 20 years, you claim depreciation. The gains are deemed to be short-term capital gains. Can I get the benefit of investing in capital gains bonds? Is a question which you will have to, I think you will have to look at it. You will have to perhaps see whether this will apply. Perhaps the ratio of VS Dempo may not apply going forward is something which you need to keep in mind. Section 92(2)M, which is corresponding to 56(2)M(10). 56(2)10 says, any amount received without consideration or any asset received without consideration or for inadequate consideration is deemed to be income. So property, you had this definition of property, which included immovable property, it includes shares, securities, it includes antiques, etc. Paintings, all that is included. Now you have this virtual digital asset is also a property. So if you receive a gift of a virtual digital asset, now that will also be taxable as income under section 92(2)M, corresponding to 56(2)10. So that is the unexplained assets. I think Piyush has covered that in great detail, which is, so I'll skip that part of it. Unexplained incomes again, which is, I think, yeah. So the deductions, now are combined in section 123, read with schedule 15. So all the details are contained in schedule 15. So you have a serial number 4, which has the table of withdrawal of deduction, taxation of deduction already allowed. You have a serial number 5, which contains the table for section number 5, which deals with taxation of receipts where deductions have already been allowed. So all that is now, NPS is a separate section. You have section 124 for NPS. 80D, which is a Mediclaim, etc., which is there. 80G is there in 133. So you have separate clauses A and B for 100% deduction and 50% deduction. So that also language has been fairly simplified. 80JJAA is contained in 146. 80M is in section 148. So separate sections are there for that. For MAT and EMT, what they've done is they've combined the two sections into one section, 206. And, it's part D of chapter 13 there are special provisions related to MAT as well as AMT. So you have IFSC unit, cooperative society, everything, non-company, IFSC unit, all that. And there is this concept of adjusted total income. So more or less, I think this provision is matched. So therefore, that one will have to just understand the placement. Now, coming to charitable trusts. Now, charitable trusts, I think there are quite a few significant changes. The first is today you had sections 4 to 6, 1023C. You had sections 4 to 6A. This trust with not wholly or substantially financed by government or which are having income gross receipts of more than 5 crore. That was one category, which was under 6 and 6A educational medical institutions. And then you had a public renown, institution of public renown under clauses 4 and 5. So now you have all that 4, 5, 6, and 6A is merged with section 11. So you don't have it under 1023C. So a ground for this was perhaps laid down where you had an amendment in the Finance Act 24 saying that with effect from 30th September 24, any approval, any institution which was registered under 1023C will now have to seek a renewal of approval under section 12A. So therefore, that was there already under the 61 Act. The beginning was there. But here under the 2025 Act, what has been done is that this has been consolidated. So you now have only one category of exemptions, except, as I said, in Schedule 7, where you have those completely exempt trusts. So those will continue under Schedule 7, but all the rest will now fall under this section, which is contained in Chapter 25B. Special provision for registered non-profit organizations, sections 332 to 355. And there you have your 12A approval, ATG approval, rate of tax, tax on accreted income. All this is now forms part of the same chapter. So they are not separate chapters. Now, so there, as I said, there are three broad categories. That is persons exempt from tax, which is Schedule 7, which gives you trust falling under the 1020C1 to 3AE, is in that section. And then income not to be included in total income of eligible persons. So Schedule 3 read with section 11. So therefore, that's another category. And this is now under Chapter 7. So for special provision related to certain persons, Part B. And you have this section 330. Within section 332 to 355, they've broken it up to subparts. So you have registration, provisions dealing with registration. You have provisions dealing with the income of a registered NPO, commercial activities by a registered NPO, the compliances part, the violations part, the approval for the purpose of deduction under 133. 133 is your ATG. So what are the approvals required there? And then there's a definitions clause, which is the interpretation part of it. Now, when you look at the definition of income under 249, it says voluntary contributions received by a registered NPO. So here now the language used is registered NPO, non-profit organization, registered non-profit organization. So earlier we used to use that held from a trust, where property held under trust only for charitable or religious purposes. Now, what they say, the trust and all that concept is not there. So the concept is registered non-profit organization. And we'll see what is the definition of registered non-profit organization. We'll come to that. So any voluntary contribution received by a registered NPO or a university or educational institution or hospital or other institution or an electoral trust or an association, which is a research association, that will be taxed as income. Now, the question, of course, is today also this question is there that what about voluntary contribution received by an unregistered NPO or an NPO substantially financed by the government? There you have section 56 to 10, which deals with that. And there here also 92 to M, sum of money received without consideration. So this will possibly apply in those cases. And now only question is, assets, if you receive donations in kind, such an unregistered NPO receives donations in kind in the form of assets which are not specified assets in the definition of that assets, property, which is there today in 56 to 10. Say, for instance, if it receives a vehicle, for instance, or is that income? Does not fall within the definition of property over there, and therefore perhaps that will skip go out. So, but these are things which we will now need to look at separately because unregistered NPO is not specifically. So now the first thing which comes to mind is this is competition of income of special persons. So therefore, this is not a scheme of exemption. Today, section 11 to 13 was part of your exemptions. So it was a manner of competition of exemption, which you did your 85% spend, 15% accumulation, your accumulation 11 to, etc. That was a manner of competition of exemption. Now, this is a competition of income. It is not a competition of exemption. So therefore, this brings it a little bit, probably easier to understand also, because this whole concept of how do you compute exemption? It was something which was, I think, was something which was. Now, given the fact that now will 14, section 14 apply, which is your equivalent of 14A, no, this will not apply. Again, if you look at the language also, because this is a computation of income, as I said, it's not an exemption. So therefore, this 14A will not apply. Section 14, the new section 14 will not apply in this situation. And again, it applies only for the purpose of computing income under the chapter of computation of income. It doesn't apply to chapter 17. Well, MAT or AMT apply, and this has been an issue today also. Say, for instance, you have a Section 8 company or Section 25 company. Does MAT or AMT apply? That question has been there, and therefore they said, no, its income is exempt, and therefore it does not apply. Here you have 2062, which says that amount should be reduced, that income to which any of the provisional 11 apply or any regular income of a registered NPO, that amount, if it's credited to the statement of profit and loss account, you have to reduce it. So therefore, that will not apply, fortunately. Now, what is a registered NPO? Section 355G says, any person having a valid registration under any specified provision, and such registration has not been cancelled. And what is the specified provision? You have 12A, 12AA, 12AB, or 1023C. So if you are registered under 12A, you will be a registered NPO. So suppose most trusts have applied for renewal of registration now from in September, before 30th September. And the registration will be granted by 31st March. Once the new act comes into force, you don't need to again apply for renewal right now until your 5-year period is coming to close. At that stage only you will need to apply for re-registration. Till then you don't need to apply for re-registration. You will be a registered NPO because you fall under this. And registration includes provisional registration, provisional approval, both 1023C as well as 12AB, but shall not include approval under 80G. So 80G is not of approval for the purpose of this because you have to be registered for your income, not for the donation that you receive. And therefore, so 12A registration or 1023C approval, both if you have, which is valid until a particular later date, that will continue, you will continue to be a registered NPO. But which means that if you had a 1023C6 approval, say for instance, and which is expiring in September 28 or March 28, you will still be a registered NPO and you will now not go under equivalent of 1023C. There's no equivalent now. Now you will have to come to this competition provisions. That's the way it will go. Now, here they've said one interesting thing that they've brought in is that only eligible entities can apply for registration, which in any case was the position because, typically it was a trust, society, or a Section 8 or Section 25 company. So they've made this clear that this is a position, and including universities, etc., that will also be covered by this. Then they said that not only you have to be an eligible entity, but you are eligible for registration if you're constituted, registered, or incorporated in India for carrying out one or more charitable purposes referred to in Section 2023, or one or more religious purposes or both. So what is important is you have to be constituted, registered, or incorporated in India. Now, there are certain foreign organizations which are registered, have got 12A in the past. I don't know what would be their position, because can you say that they are constituted, registered, or incorporated in India? I don't know whether that would, they would qualify, is I think a question which perhaps is an unintended lapse. Properties of such person are held under an irrevocable trust for the benefit of the general public. So your concept of property held under trust for charitable or religious purpose, that is brought in over here. That you have to hold, you don't become a registered NPO, you cannot apply to be a registered NPO unless the property is held for irrevocable trust. It's wholly for charitable or religious purposes in India. Now this is again another problem. Today, what happens is, if you say that this is for, say, educational purpose, what you spend under 11(1)(a), what you spend for charitable purposes in India is exempt. If you want to spend outside India, you have to take the prior CBDT approval. But primarily, you can spend in the first place for outside India if your object permits you to do so, if your trust deed permits you to do so. If your trust deed does not permit you to do so, you cannot even apply. Now, here what happens is, you have to be wholly for charitable or religious purposes in India. Only then you can apply for becoming a registered NPO. So, how will you ever be able to go to the CBDT and say that, no, allow me to spend outside India? That provision is also here under the new act. So this seems to be again a drafting mistake, because obviously, unless I have that as my object of spending outside India, I cannot go to the CBDT. And if I have such an object, I cannot become a registered NPO. So therefore, that seems to be a drafting mistake, I think, over here in this whole thing. And then partly for wholly or charitable register, if you were prior to 1st April 62, which is still there, which was there. Then question is, you are eligible for registration, but wholly exempt trusts which fall under Schedule 3 or Schedule 7, do you need to apply for registration as a registered NPO? Now, there, if you look at this ATG equivalent, which is section 354 approval, it's only for registered NPOs can apply. So if you want your equivalent of ATG, that is, you'll have to then apply, you will have to become a registered NPO. But otherwise, if you do not want that, and today, of course, ATG in many cases, people say, no, why don't we want ATG? Because the donor in any case, because of the high exemption limit which is there. So the donor in any case does not want to claim the benefit, etc. So therefore, do I need ATG at all? Is the question mark, because many people opt for the new regime now, and particularly from this current financial year onwards, I think most taxpayers will be better off under the new regime. So they may not want to apply even for ATG, but what happens is ATG is important from a CSR perspective. Because unless you have your registration under 12A and ATG, you cannot accept CSR donations. So therefore, people would want to have this ATG. And so therefore, even if you're a small school with a gross receipts of less than 5 crores, you may still want to register as an NPO just to be able to get your equivalent of ATG registration. So that is something which you will have to remember. Definition of charitable purpose, you have the same clauses, the same 7 limbs of charitable purpose which are there, relief for the poor, medical relief, education, etc. All that is still there, the same advancement of any other object of general public utility. Only thing is the proviso is taken out from here. The proviso comes in a different form. Proviso to 215 is not here. So don't be very happy that the proviso has gone away. It's there, but in a different form. And how does it come in? Let's look at that. So time limits and validity for registration, I think it's more or less the same. There is hardly any change in that. So you have under 12A, 1AC, you have those 1, 2, 3, 4, 5, 6, and 6A and B. So 6A and B has been broken up into two separate things. So it makes it easier. There's a table over there, which makes it easier to understand in what situation. How to condone the delay of registration is there. That 5 crore you have for a period of 10 years. If it's less than 5 crore, more than 5 crore, it will be for a period of 5 years. So that all that is the same, more or less, is, I think, clearly the same. There are provisions for cancellation of registration also. Similar things are there. So let's go then to this income of a registered NPO. What is this concept of income? And there they say that in section 334 says that a registered NPO will pay tax on its total income, which is the aggregate of the tax payable will be 30% on the specified on the regular specified income. So specified income is an income which is taxable at a flat rate of tax, and rate applicable under other provisions on taxable regular income and any residual income. So here there is no rate which is specified. So therefore, you will have to go back to the Finance Act of each year. So today also the rate applicable to an AOP BOI, which is the rate applicable to individual HUF, the slab rates apply. So therefore that will be, so a regular income, taxable regular income will be again as per the Finance Act. What is the meaning of residual? So there are 3 types of income: specified income, regular income, and residual income. Now, what is the meaning of residual income? And they've said the definition is total income as reduced by regular income and specified income. So your total income consists of these 3, and your regular, the thing, what does not fall under specified and regular will fall under residual income. That's the way that they've. Now, tax competition under these provisions will be applicable irrespective of the nature of income. So therefore, if you have a special rate under 115BAA, your 22% rate, whether that should apply, whether this would be applicable, that's the question. Because here also this says irrespective of anything else. Whereas there also, if you look at section 200, which is the rate of tax, it says irrespective of anything contained. So therefore, seems to be a clash of this thing. So the question is, what would be the rate applicable to a Section 8 company? Is a question which is, can it opt for the special rate of 22%? Is a question mark which will arise, or will it go by the Finance Act rate? What about the rate applicable to long-term capital gains? Or would it go by rate of taxable regular income and residual income, which is your slab rates of tax? Again, I think there seems to be a little bit of a lack of clarity on that. But the way it appears today, that it perhaps is that it would be the slab rates of tax and not the capital gains rate, which perhaps, again, I don't know whether this was intended or not, but that's the way it would. Section 334(2) says provisions of this chapter apply irrespective of anything to contrary contained in any other provision of this Act. And other than sections 96 to 98. 96 to 98 is the revocable transfer cases. That today also you have section 11 starts with other than, unless the thing following under section 61 to 63. So section 11 is subject to section 61 to 63. So here also this is, other than section 96 to 98, revocable transfer will prevail over this. So if you have a trust which is settled, which is a revocable transfer, then obviously this provision will not apply. So there is no competition under other heads, under heads of income. Question is, can GAR provisions apply? Section 170 says, irrespective of anything contained in this Act. And whereas Section 334 says, anything to, irrespective of anything to contrary contained in any other provisions of the Act. Again, there seems to be a bit. So far as Section 102, 103, which is your 68, 69, etc., would this unexplained credits, etc., apply? And this has been an issue which has been before the courts, where a charitable trust has received voluntary contribution. Can Section 68 be applied? Then there the courts have said, no, it's anyway income. So where's the question of treating it as Section 68? And here also there is no overriding clause in Section 102 to 105, which will apply here. So and I would believe that therefore the normal competition of provisions for a charitable trust would apply in this situation. So as I said, that regular income in case of this is used in place of income derived from property held under trust for charitable religious purposes. And regular income is defined. Now here also what happened is, at a bill stage, this used the language receipts from charitable or religious activity or receipts derived from property, deposit or investment was the language used. Now, which would have created a difficulty because there they said, and receipts capital or revenue was the language used. Now, which meant that if you had a fixed deposit which matured, that would have become your income. That was the problem. And therefore, this was pointed out and this was corrected. Therefore, at the Bill Act stage, it says now it's an income from charitable or religious activity for which registered, or income derived from property, deposit, or investments held for charitable or religious purpose, voluntary contributions, and gains of commercial activity permitted on 344, 345, 346, computed in the prescribed manner. The question here is, this whole concept, you had a 1968 circular which says that the commercial concept of income is to be considered. Now, will that commercial concept of income still continue under the 2025 Act? And I would believe that unless that circular is withdrawn, perhaps yes, that would still continue, that commercial concept of income. Question is, what about allowability of deduction for income tax? See, income tax was held to be an allowable deduction because if today, let me put it this way, you have 100 rupees income and you paid 60 rupees income tax. So you have only 40 rupees to spend. How can you spend 85? So therefore, it was impossible. And therefore, the commercial concept of income, they said tribunals and the courts had taken a view that 100 minus 60, so your income is only 40. So 85% of 40 was what you're required to spend. I believe that perhaps that will still hold good because of the concept of that commercial concept of income still holding good. That is the way. What about corpus donations which are not exempt, whether it will be regular income? And corpus donations, again, today you have under 11(1)(d), it says, corpus donations received with directions from the donor in, specified in writing by the donor. And the second part of it is, provided they are invested in mode specified under section 11(5). Now, what if they are not invested under 11(5) modes? Then would you be still eligible? That is the question which comes up. And there I would believe that non-exempt corporate donations may perhaps fall under regular income because they would be voluntary contribution received in such tax year. But I think that's something which, again, maybe one would have to spend a little bit of time to understand. Now, what is your taxable regular income? Because what is taxable is your taxable regular income. And here, what they've done is instead of saying that you will get 15% accumulation, what they've said is 80% of your regular income will be your taxable thing. If you if you spend more than 85%, it's nil. Otherwise, 85% less what you have actually spent will be your taxable regular income, is the way that they've. And of course, as reduced by the accumulation. So the accumulation and this, at the bill stage, they had sought to remove option to spend in subsequent year. That sought to remove the exemption for capital gains. At the Act stage, this has been restored. So primarily, you still have the option of spending in the subsequent year. You still have, which you file your form 9A. You have the option to accumulate for a period of 5 years by filing your form number 10. And you also have the exemption for capital gains by reinvesting in a capital asset. That also has been continued. So that has been restored in the Act stage, fortunately, I think, because there were serious problems if the way it was proposed had gone through. And the other thing is this 15%, which, in any case, because you are 85% of your regular income you're taking. This 15% they're saying is deemed accumulated income. At the bill stage, they said that the deemed accumulated income also has to be invested in mode 11, specified in level 5. Now, very often that may not be available with you because of the fact that, say, for example, you donated to another trust. Now, that money is not with you. So, how can you invest? So, therefore, now they've said that, okay, if you are invested, it should be invested mode specified in level 5, which is fine. I think that's the way it is today also. And there is no problem there. Then the spending outside India, now, there was a controversy about what has to be outside India? Has your objects to be outside India or has your actual spending to be outside India? There was a controversy on that. Delhi High Court has said that no, the spending has to be in India, irrespective of what your objects is outside India or in India. Karnataka High Court had taken a view that no, your objects, it does not matter where you're, sorry, they had said that so long as your object is in India, so even if you spend outside India for your objects in India, there is no problem. That was what the Karnataka High Court had taken. Now here it uses the language income, because there the language was income applied within India for charitable purposes. Income applied for charitable purposes in India was the language. So whether application has to be in India or charitable purposes has to be in India was the difficulty. Now the language is income applied outside India. So today what will happen is, if you want to spend outside India, you have to take the approval of the CBDT. So if you want to import a machinery for your hospital, you need the CBDT approval, the way the language is. You want to send your students for a course outside India, you will need to take the CBDT approval. You want to have foreign faculty come from outside India to teach in India, you will need the CBDT approval. You want to pay for the students who are taking examination course outside India, they're paying for the foreign examination, you're remitting fees over there, take the prior CBDT approval. Now, this is something which I think, I don't know, this would be a large number of cases where this would be required. And this is something which perhaps may need a relook, because these applications, they take a long time to be decided. And if I make an application that my students are going in 6 months hence, and I make an application today, and an application is not decided for 2 years, it doesn't serve the purpose. So that's something which perhaps, or unless a timeline is laid down for disposal of these applications. So corpus donations, again, the same language, similarly, specific direction from donor, this issue will continue, whether it's required to be in writing or not. Earmarking of corpus investments is required, which is there today also, that will be required. In absence of meeting the conditions, would this be treated as regular, and corpus donations received in kind? Again, the same issues which are there today, that those issues will still be there. It's, if you see the definition of regular income, perhaps, there are two views on that. If it's excluded from regular income, you will not get your 15% accumulation. That's something which you will need to keep in mind. Here, then you have the same thing, application of income, you have section 341. What is allowable as a deduction? That amount applied, 10,000 rupees, no TDS cases, etc. All that is there. And, if you're out of borrowings or out of the amount out of corpus you utilize, and then when you recoup the corpus or when you repay the money, in that year it will be allowed. Same provisions are there, application of income. Then you have amounts not to be claimed, depreciation, where you claim the cost of the asset, again, set off of excess application in the earlier year, etc. All that still continues. Now here, interestingly, what they said is application for corpus, loan or borrowing or accumulated income today also is not considered as application. But they say that application from specified income or deemed accumulated income also you will not get, obviously, because that is taxable, perhaps that is the other thing. So this option to spend in subsequent year, as I said, that has come back. Capital gains, again, if you utilize the net gains and the net consideration, utilizing a new capital asset. Accumulation, now here in accumulation, 11.2 allows you that you have to state the purposes of accumulation. Now here the language here is stating there is a purpose and period. Now by using the language purpose instead of purposes, perhaps would it make a difference? Because it doesn't mean that only for one purpose, because courts are taken a view, you can have multiple purposes of accumulation. So therefore, this seems to be again another unintended this, that the S is missing over here in purposes. So here also, as you know, this controversy about purposes versus objects. Can I reproduce my general objects? So there again, this has been the controversy for the last 40 years since Singhania Charity Trust case. Now, therefore, this was an opportunity to have to correct that, but and that language is used, so therefore this controversy will continue. So this is something which will specified income, basically what was tackled under 115 BBI, where your accumulation which expired, which was not spent, or where you give benefit to a specified person, or investments made in which were not permitted, etc. And your anonymous donations under 115 BPC. Both these have been put together into one table, and Section 337 has this table. So this is and here also anonymous donations, there was that partly charitable, in the bill stage, there was partly charitable, partly religious. All anonymous donations received by them would have been taxable. But fortunately, I think they've now restored back to the current position, which is there under the 61 Act. So similar language. So, yeah. So anonymous donation, that is unchanged, then related person, that's now only one thing here is that you have section 13(2), which gives you a list of illustrative cases under which a benefit is deemed to have been received by a specified person. Now that list is no longer there. So therefore, now it will go on general principles. Has a benefit been received by a specified person? So therefore, that will be the same. Now, it says income applied for the benefit of. Now the question is whether a lower charge for use of an asset by a related person, whether that will be covered now is a question mark, because that was specifically there under subsection 2, which is not there now. So therefore, that is the same. And of course, that impermissible investment made out of any income. See, what happened is that today, let me put it this way, that you have an income of 100. You make an investment of 150 out of your corpus or of your past accumulation, etc. You make an investment of 150. Now, what happened is that what was taxable under 13(1)D is to the extent of the applicable investment. Now, you can lose exemption only to the extent of income for the year, which is 100. So therefore, only 100 became taxable. Now, what they're saying is this entire 150 is your specified income. So that is something which, which is now applicable. So this is a difference here. Then, Then commercial activities. Now, commercial activities, I'd just like to point out one thing. What they brought in is commercial activities, they brought in section 344, which is like your 11(4), where you have a trust held for charitable purposes. So therefore, that is the thing. So that is one category where it is property held under trust. You have settled a business on trust. So that is one category. The second category is where you are a GPU, non-GPU category. And the third is the GPU category. So these are the three categories. So you have section 344, 345, and 346. And there they have this concept. Now, the real problem is this, that just like the proviso to 215, today you lose your exemption, 1310 applies, you pay tax on the net income. So that provision is still there. But the one provision which is there and which will be really hurting people is there is a concept of specified violation. You had section 11(4)(a) said that if you have a carrying on business, that business should be incidentally your charitable objects and separate books of account should be maintained. If you don't observe 11(4)(a), then you lose your it's a specified violation, your exemption can be cancelled. Now what they have done is they've combined this with the proviso to 215 for GPU trust. So therefore, if you have a GPU trust whose gross receipts from a commercial activity exceed 20% of its total income, then its registration can be cancelled. Now, it's not only that it pays tax on under 1310 on the net income, but its registration can be cancelled. Now, this is something which is far-reaching, and today it was only one doesn't mind paying tax on that, because there's very often a dispute: is this a business or not? Is this a commercial activity or not? And as you know, these matters have gone to the Supreme Court, and they still continue to. There's a lot of litigation on that. But this is fairly harsh, that saying that it's a specified violation. I think this is unintended. Perhaps let's hope and say that in this budget, whether there'll be an amendment on that. That's the this thing. So, as I said, So, of course, non-maintenance separate books of accounts, in any case, under 1148 today, that can be result in a cancellation of registration. Compliances, there's one interesting thing here is that, if you don't file, so yeah, the return of income within time, then you lose the benefit of exemption. That's the thing. Now, delayed filing perhaps may not be covered under this. So you're required to maintain books of accounts, other document that continues, where it exceeds the maximum amount, accounts required to be audited and audit to be prescribed by the prescribed date, etc. So, you have this, specified entity. The investments list is, you'll find it in Schedule 16. It's almost identical to today. What is there, you'll find under Rule 17C as well as Rule Section 11.5. So that is identical. So therefore, there is no change. So, now, if you look at this, where can you, there's taxation or if you violate, and what is the provision? It says, where it fails to maintain books of account, fails to get books of accounts audited. So not audited within time, that language is not there. So delay may not get hit. It fails to furnish its return of income. Again, delay may not get hit the way the language today is. Because today, even a delay is hit by this, you lose your benefit of exemption. So it's only failure and to file return or failure to get it audited, which will be chargeable to tax. Section 1310, today there is no exemption for corpus donations. The question is, perhaps the position 338, that, there is a little bit of a gap over there, and that's where you can maybe look at this, that this is something which voluntary donations are regular income. So will you get the benefit is a question mark over here. So again, 1310 is contained in Section 353. Tax on accredited income, that exit tax which is there for charitable trust, that's still there over here as well. Similar language, a similar position. That is there is hardly. Coming to your return of income, your normal return of income, you have Section 263, which is corresponding to Section 139. So there was a hue and cry that a new category of a person who intends to make a claim of refund, which was there in the appeal stage, that has been deleted. So therefore, that is not there. Reassessment, the time limit is now 4 years, but it's not increased 4 years or 6 years because it is 4 years from the end of the tax year. So today it is 3 years from the end of the assessment year, which is the same. So really there is no change effectively, but people sometimes think that there is a change. And, really, I think there is search and survey with block assessments, I think. On TDS, I will just take a little time on TDS. Now, this is combined all these sections. 192 continues as a separate section. So therefore, but other sections you have from 193 onwards up to, they have been combined into one section. So, and you have subsections dealing with various types of payments, and you have table under each section. This is, I think, very well done, frankly speaking. So you have subsection 1 will deal with payment of income to residents. Subsection 2 deals with payment of income to non-residents. In some cases, the rates in force, which has been prescribed by the Finance Act. And you have a residual clause 17 for payment of, which is equivalent to your 195, which says payment of any interest or any other sum chargeable under the provisions of this Act at the rates in force. Payment of income or sum to residents, such as lotteries, winnings, cash withdrawals, and then remuneration interest to partners or partnership firms, etc., will fall under subsection 3. Cases where tax not to be deducted, the below the threshold limits or pass-through incomes and all that falls under subsection 4. Now, 197A declaration for non-deduction of TDS, now you'll find it in 393.6. There's a table over there. For lower deduction TDS, it's under section 395(1) by the payee, by the payer to the non-resident under 395(2). For all the payments, it can be, as Piyush mentioned, can be made for all types of payments. And here now there is provision for cancellation of a 197 certificate, which is already granted. So today there is no provision for cancellation. Here there is a provision now for cancellation, but after reasonable opportunity of being heard. The requirement of issue of TDS certificate still continues. Now here, some of the interesting amendments which you need to keep in mind, that the term likely to be paid or credited during the year is not used at all in this. So this has been, so therefore, only if the payment exceeds the threshold without regard to likely payment. So if I'm going to pay, say, interest of, say, a lakh of, I'm going to pay interest of, say, a lakh of rupees, and the limit is, say, 50,000. and I pay 25,000 the first quarter, 25,000 second quarter, I don't need to deduct TDS. So only when it exceeds the limit, then I need to start deducting TDS. That's the way it is. So likely to be paid, I don't have to look at. Though for practical purposes, I basically prefer to deduct, when I know it's going to exceed. Now, this credit to suspense account, this was earlier to be found only in certain sections. So, interest on securities, interest, payments to contractors, etc. Now this applies across the board. So under 194R, for instance, for free samples, you make a provision. You are required to deduct TDS. Now, how will this work? Because I will not know which will exceed 20,000 or not, because I would have made a provision based on my estimated this thing that this is what I'm. So the payee may not be known. So therefore, this is something which will create problems for many of these sections. Because now this applies even for purchase of immobilier property. It will apply. It will apply for everything. It will apply. Then, as Piyush mentioned about time limit for filing correction statement, that's been reduced. So therefore, by March 26, you need to, I think, ensure that the earlier periods you deduct, we file your correction statements. Interest on security, now the limit is 10,000 in all cases, which was amended by Finance Act 25, of course, similar this. Cash withdrawals from bank, now that there's a common limit of 3 crore for all persons, other than corporate societies. That lower limit of 20 lakhs for non-filers, that does not apply. So therefore, non-filers and etc., there is no separate category over there. TCS now, this is collectible at the time of debit or receipt for all types of transactions. Earlier, it applied only to certain specific types, but now all types of transactions. So therefore, TCS, you will have to look at that. And 194th R3, which is, benefit provided to persons. There was this proviso which said that CBT can issue guidelines which are binding on the taxpayers as well as the department. Now that has gone away. So it's now you only have section 402 where guidelines can be issued by the CBDT, which are beneficial guidelines. That's the which. DTW, I think Piyush has covered where, the terms used, etc. Associated enterprise, again, I think. Now, of course, the question is, there was a Supreme Court decision, the went up from the Ahmedabad Tribunal, the matter went up to the High Court, High Court, and then the Supreme Court upheld that in V. Gem's case, where they said that only if you fall under subsection 2, then you would be an associated enterprise, because subsection 2 is, a specific section, whereas 94A1 is the general section. So that is what, now that they have put it all into one, combined the whole thing. So therefore that question will not arise. So therefore that is, where more than one proviso to 92C2, that where more than one price is determined by the most appropriate method, the arm's length price is to be the arithmetic mean is the current position. Now they are saying that the price will be determined in such manner as may be prescribed. So therefore, that's something which we'll have to see. And so question: if you have one single arm's length price or versus multiple arm's length price, does this 3% apply even a single arm's length price? So there was a doubt on that, and now that's clarified that yes, even if you have a single arm's length price, there's a variation of 3%, which is something which will be applied. Faceless assessments, etc. All these continue the way it is, and the schemes notified under 60 Act will continue. I think that covers more or less the points which I wanted to cover. Well, thank you. And if we have time, we can take a few questions.
Friends, I request everyone to please not to go in the vote of thanks. And now we
Sir, I saw in the previous slide that it applies to all credits, and earlier it was only to specific interest and any all credits means.
see, today you have